We're Compound Everything, and we talk about money, markets, and investing, and everything in that genre. And today we are talking about bonds, which is a little bit of a pivot for us because mostly we talk about stocks, also known as equities. But today we decided we'd do what is a bond and what brought us here.
Well, a couple of reasons. One, as probably our viewers will know, we're actively doing the Canadian Securities course, just for interest's sake more than anything else, and to just bone up on learning and whatnot. The main reason I think we're going to talk about bonds today is Silicon Valley Bank. And that's all over the news right now. It's a bank, I think it was the 20th largest bank in the U.S. or something like that, by assets or something. And it's gone belly up. And it went belly up largely because of their long-term bond holdings.
Right.
So what ended up happening was without getting into too much description of it, is they had a bunch of long-term bonds, and I guess people were starting to pull assets out, and because they had these long-term bonds that had long-term maturities, they can't just readily, they can sell them, but they're not going to get their par value for them.
Right.
So they ended up having to sell some of those assets at less than they bought them for, and they're running into trouble, and people started to pull out more money, so they had to sell more assets, and it snowballs.
And essentially they had a run on the bank.
And
they couldn't liquidate their bonds.
Yeah.
They could liquidate their bonds, but they couldn't liquidate their bonds at the price that they needed to in order to have the money. Yeah.
So I think an important thing to understand about that, and we'll just go over this really briefly because it leads into our discussion, is a long-term bond is good if you hold it to maturity. So let's say they have a bond that they bought for $1,000 for each bond, and it's a 30-year bond. Well, if they hold it to maturity, they're going to get their interest payments, every 6 months until that matures, and then they get their principal back.
Yep.
So they get their $1,000 back, and the whole time they've collected those interest payments.
Now, with that being said, I think that is where a lot of retail investors and people not in the investment world don't understand why these long-term bonds are causing such a problem, right? Because myself included, and people like my grandfather, who was heavily invested in bonds, only thought of bonds with the idea of holding to maturity.
Yeah.
My grandfather never bought bonds to trade them. Right? He would buy Government of Canada bonds, he'd buy some municipal bonds and whatnot, and he'd buy bonds for the grandkids, and we would cash them in at the end of the term. We get the par value back, and we, like you said, would collect coupon payments. Now, when people who are not familiar deep into bonds, and actually a lot of retail investors, including myself for a very long time, I didn't understand even what bond trading was. So when someone says, well, they couldn't sell their bonds, that wouldn't make sense, because I didn't realize that you could trade bonds in and out of before their maturity. So that is the issue here, because a lot of people don't know that.
So I digress a little bit. Maybe we'll circle back to SVB once we've kind of talked about bonds a little bit and given a description of what it is and whatnot. So what is a bond? So a bond is essentially a contract between either two businesses or business and individual to lend and borrow money. So that's basically, the bond is a contract. So let's say you have a company like Apple. Apple recently issued bonds. I think it was maybe a year ago or so. Apple comes and it says, well, do you want to buy our bonds? And they say, we'll pay you this much in interest payments, and we'll give you your principal back at the end of, let's say, 5 years. And you collect those interest payments, whatever they are. Usually semi-annually. So every 6 months, you'll get an interest payment of, let's say it was 3%. So you'll get, for every $100 you buy of the bond, you'll get $1.50 every 6 months until maturity. And at that point, you get your last interest payment and your principal back, which would be the $100. So usually bonds are traded in par value of $1,000 or some other denomination. But they're usually quoted in $100 derivatives. It can be more, though. I mean, they could be $10,000 million bonds and whatnot. So usually the particulars of that are identified in something called a trust deed, which is basically a bond contract. Now, this can be like 100 pages long, and it gives all the legal jargon about, what happens in the event of default, and
who gets paid
first, and this, that, and the other thing. So the long story short is bonds are usually traded or quoted in $100 or 100 increments.
If you hear par value, that means $100.
Generally speaking, And so you can go and look up bond quotes, and they'll be quoted in 100 increments. But usually you have to buy them in certain denominations of like $1,000, $5,000, or whatever it is, blocks of some sort.
Another thing that people might not realize about bonds is it is actually a much larger market than the equity market.
Yeah, I didn't know that.
And I didn't know that either. Yeah. And it's because equities are kind of like the thing that everyone does right now, and stocks are what retail traders do and everything. But the bond market is actually much, much, much larger than the equity market, and that makes a lot of sense now when you're looking at banks and this and that and big institutional
investors,
owners and whatnot.
One thing to know about bonds is a bond is generally a asset that is backed by some sort of collateral. So your mortgage would be a bond. In essence. So if you go to the bank and you say, I want to borrow some money. So the bank says, sure, we'll lend you that money, but we want something as collateral. And so you say, okay, well, I'll put up my home as collateral for the bond. Right. And so that's essentially a bond. That's the bond between you and the bank is the mortgage. So your mortgage is a bond.
Right. And if you default.
And if you default, then the bank can come and seize your home. And so they can then turn around and sell that and obtain whatever value they can out of that to recoup the money they lost. So that is essentially the same thing that happens with a bond. So a bond, by definition, is something that is backed by some sort of an asset. And the other terminology that goes around is something called the debenture. So a debenture is another fixed income asset, which is like a bond, but it is unsecured. Yes. So government agencies will usually release debentures. So they call them, so in Canada, we have Government of Canada bonds. But those technically aren't bonds because they're not secured by any physical assets. So technically, they'd be a debenture.
Right, and it gets somewhat confusing by the quality of the person issuing them.
Correct.
Right, so a government bond in Canada or a debenture in Canada is backed by the government, is backed by the name, the entire country, and how good the quality of that.
And their ability to tax its citizens and so forth, so on and so forth. So a bond is something that's secured by an asset, and a debenture is an unsecured.
Yeah, secured loan by the name of the whoever's issuing
it. And of course you can get into other things as well called guaranteed income certificates and other those things are also fixed income, but we won't talk about those.
But GICs right now, funny enough that you mentioned them in Canada, they have been, for the first time in a long time, they've been worth looking into.
Yeah, I mean right now, as of the other day, I looked into guaranteed income certificates, which is abbreviation is GIC in Canada. You can get 5% for a 1 year GIC.
For 1 year, risk-free. And GICs are essentially risk-free. And that hasn't been, you haven't been able to buy a GIC for 1 year with a 5% return for, probably since we got married, which was 23 years ago.
Right. Yeah. The yields on fixed income are getting better and better. So it becomes something to actually look into a little bit more. So going back a little bit to bonds, you mentioned the bond market is huge.
Yeah, really.
And I didn't know that. And part of the reason I think that is because there's, I guess, just in essence, like stocks, there's a primary and a secondary market for bonds. So what does that mean? Well, oftentimes a company will do a bond offering and some large investment bank or whatnot will buy these bonds and then kind of try and sell them to various customers and whatnot. And that constitutes then a secondary market. So what ends up happening is the company will get let's say they decide to issue $100 million of bonds. They'll get that $100 million, minus a certain fee from the bank, and they'll get to put that in their pocket. Right. Now then those securities, those bonds or debentures, whatever they are, will then go ahead and trade on it. It's called a secondary market. So there'll be a secondary market for those bonds. And that's where you and I can trade them. So if I go and buy a bond, so let's say I buy it for $100 par value, the price of that bond may go up and down over the lifetime of the bond. Yeah. And so depending on the creditworthiness of the company, depending on the interest rates that are prevailing, and there's a number of factors that may make a bond's price, the face value, go up or down in the secondary market.
Yeah. And one thing that now here's the thing, you are actually interested in trading bonds. I have zero interest in trading bonds right now. I also started trading stocks much later than you did. So I'm still not even feeling totally comfortable in that realm yet. But one thing, when you started looking into buying bonds on the secondary market, you had a very hard time figuring out where to even find them. Yeah. It's almost like the financial world's little secret.
It seems that way.
It's like everyone knows they're out there, but you don't have the same access as retail. So that's interesting.
There's no bonds app on your iPhone.
No.
There's a stocks app and you can easily put a little ticker in there.
Yeah.
But it's hard to do that for bonds. Although debentures do show up.
Yes, they do.
If you do that.
Yeah, I was going to say, I really feel that they don't want retail in that. I get the impression that the financial world and the professionals don't necessarily want retail in deep into the bond world. They want to keep that portion of the market for themselves, because they definitely do not make it super easy. It's not as easy as stock.
It's not easy. So, in certain platforms or whatnot, you may be able to kind of go get bond quotes. And these are only daytime quotes. You can't get them after hours, funny enough, because it's again, a secondary market. And it's usually through your own banking institution that you're going to get this. And you'll see what bond offerings they have if you go and click on a fixed income tab. Usually that's how it pulls up.
And it's not impossible, and it's not super difficult, but it's just not as accessible as stocks.
No.
And there must be a reason for that.
Now, having said that, on the platform we use, if you just put it into your stock quotes area, if you kind of type a name, so for instance, Well Health Technologies is one of the ones I was just looking into out of curiosity's sake. I just stumbled upon it. If you type in Well, you can actually find their debentures, and their debentures come up. So, and that's under a stock quote. And I'm not sure why bonds and debentures will come up that way. I really have a hard time with that one.
So I'll just recap that. Yep. So that is it. So when you're buying a bond, that is what you're looking for. You're looking for your yield. You're looking for the price at which you're going to buy it. Are you going to buy it at a discount? Are you going to buy it under $100? Are you going to buy it at premium? Are you going to buy it over $100? You got to keep interest rates in mind, because interest rates are very important to the value of a bond.
And there's ways to calculate that.
Yeah. Are you going to hold it to maturity? Are you not? So with that being said, are you looking at Well Health Technologies debentures?
I actually just stumbled on them. So for whatever reason, I was reading about the company. I just got interested in them.
I only asked because maybe you would. I would never invest in that company.
Yeah.
So that's why.
Well, I was reading their annual report.
Okay.
And then I noticed that they had debentures. And so I thought, oh, that's interesting. And I noted they had something called convertible debentures. So what's a convertible debenture? So a convertible debenture is basically a bond that is not secured, as we talked about before. So you lend them, you're lending the company money, and they're paying you coupon payments. But in addition to that, they do something to sweeten the deal a little bit, which is to give you a conversion option. So what that means is you can convert your bonds into shares of the company.
Yeah, and that's pretty nice.
That is pretty nice. So usually in a bond, you don't have the opportunity. So let's say you have a company that is like Well Health Technologies that you think is going to do really well in the future. If you just bought a bond, then you'd have no opportunity to participate in the success of the company other than you're going to get your money back at the end of it.
Right.
But with a conversion feature, what ends up happening is if the price of that stock tends to appreciate dramatically, then at that point you can convert that debenture into actual stock.
Right. And correct me if I'm wrong, I think Warren Buffett does convertible bonds.
He's done convertible to bonds many times in the past.
That's what I thought.
Yeah. So it's a bit of a sweetener. So if the company again does really well, then the bondholders do really well.
Exactly.
Because they can convert those debentures or bonds into shares of the company.
Right.
But if you really believe in the company, then if you buy the debentures, then you're getting these regular interest payments as long as they can repay you, as long as they can keep their interest payments going, and you get your safety of principal with the sweetened, potentially added bonus of a call option on there, which is basically where you can convert those into shares. So let's say Well Health Technologies does really well over the next, ostensibly 3 years, and they're now trading at $15 a share. I can convert those debentures if I own them. We're not long those debentures or the company itself.
And it's not investing advice.
And it's not investing advice, but I could convert those bonds into shares at $15.
Right. So even though you bought the bond.
Even though I bought the bond, which was worth much less.
Right. And in the meantime, you were getting those interest payments along the way.
The whole way. Yeah.
So that if you really believe in a company and if you really think that there is growth there and you know how to value bonds, that is quite an opportunity for an investor.
I agree. Yeah. Now there's many complexities that go into that. So you have to read the sheet that they put out outlining the details of the debenture. And again, it's lengthy reading. It's legalese. It's pretty boring. But at the end of the day,
and you have to understand a lot of lingo. You have just so many different things.
Right. You have to understand. Are they subordinated bonds? Are they? Yes. So where do they rank in terms of default and whatnot? And I think these are all things that factor in.
It's complicated.
It is complicated.
It's complicated, and so I think that keeps a lot of people out. Now, keeping a lot of people out might give the retail investor an opportunity to find situations that will really bring a fantastic return.
For sure.
But it takes time. It takes digging. Effort. It takes digging.
It does. So I'll go back to Well Health Technologies, actually, just as an example of price fluctuations. So we'll talk about Well Health Technologies for a second and their bonds and they're trading up right now. Now, we mentioned before that bonds can trade above and below par value. So par value for Well Health Technologies and all bonds is basically 100. Okay. So when Well Health sold their bonds, they would have sold them at a par value of 100. And when you receive your principal back, you will receive it back at 100. Now, if you hold to maturity. Now, presently, Well Health debentures, they're trading at 88 per debenture. And so that is a discount to the face value. So essentially, if you were to buy Well Health debentures, you would be receiving the regular interest payments, and then you get $100 back at the end of the term, which is December 31st, 2026.
You wouldn't get the 88 because you get the par value.
Because you get the par value back. So you're actually getting more than you paid for it. So there's ways to calculate that and what is a fair value for the bond, et cetera. We'll go through that maybe next week.
And the future cash flows, what are the future cash flows for the bond, what is the yield for the bond, all of that.
Right. And so we'll go through that next week. And it encompasses, what is the coupon payments and what is the discount rate you want to use. There's various
it's just
factors
like
that
valuing stocks has certain calculations that you do. Bonds also have their own calculations that you would use for them.
And part of the reason they're called fixed income is because you know and you can predict the income you're going to get if all things go well. And the company does not miss any interest payments.
If you buy a Government of Canada bond at issue, it's very easy to know what your return's going to be.
You're going to 100% know.
Right? You're going to buy $1,000 worth. You're going to get that semi-annual payment of whatever they say, I don't know, 3%. And then you're going to cash in at maturity and you're going to get your $1,000 back. It's very easy to know, which is why a lot of retired folks like to use bonds. But again, they don't get into the bond trading. They don't get into the secondary market of bonds where it gets a lot more complicated. And that is just something I think a lot of people, not in the financial world, don't even know really exists. Or they kind of think it's just like it's only for the professionals.
So some of our viewers may go, well, why is Well Health trading at $88 par value when you're going to get $100 back later?
Who would do that? Who on earth would buy that 100 and sell it to me for 88 if they could get their $100 back if they just waited?
Well, there's a number of factors there. One is the creditworthiness of the company.
What is the creditworthiness of? Well,
funny enough that I just looked it up briefly this morning. It doesn't appear that there's any ratings agencies that have covered it. So Moody's or S&P. But there's basically different ratings and whatnot that you can give to these bonds, as you've alluded to, and a lot of ratings companies will rate them. So Moody's or S&P, they'll rate these bonds. You can kind of determine what the rating should be. And now the funny thing is a cut in rating can actually cause a really significant drop in the bond value. So if Moody's is covering it and they go, ooh, we're going to drop our rating, so the bond price will probably drop based on that because this has become a more risky company.
Now, if a bond rate drops, obviously the debentures for Well drop because they were 100 and now they're 88.
Well, that could
why wouldn't that person hold it? Let's get back to that.
Right. So that could be part of it. So maybe the creditworthiness of the company dropped a little bit. Another factor is, well, what is their coupon payment? So their coupon payment right now is 5.5%.
Okay.
And so that's per annum. And as we know, the risk-free rate has gone up dramatically since when they issued those bonds. So
how long ago did they issue them?
They issued them, I think it was 2021.
Okay.
So at that point, you can look at a risk-free rate of a government bond. I think is now in the realm of 3.5% or something like that. Or you can look at Well Health, which is considerably more risky, paying you 5.5%.
Right.
And you're probably going to lean toward the risk-free payment. So that's also going to, at that difference. So that's also going to cause the price of the bond to drop. So prevailing interest rates.
Right.
And that's going to factor into what you would call a discount rate when you're doing your bond calculations later on. So that's another reason it will drop. And so there's ways to calculate what your yield's going to be, your yield to maturity. And again, we'll go through those next time.
And there's ways to figure out what discount rate you would use.
So those are really some of the reasons why a bond will drop and they'll trade for less than their par value. And the converse is true if they'll trade for above their par value.
Yes.
So let's say a bond or a company's creditworthiness went up substantially. So it was a risky play for a while there, but their business has improved and people are getting more sure that they're going to get their money back. So it may trade above par
which
value.
They call premium, a premium. In the bond world, they would say, it's trading at a premium.
Yes. And then, or conversely, the interest rates drop. So if a drop in interest rate on something that's paying 5.5%, if we drop again interest rates to 0.5%, that 5.5% cash flow bond is looking pretty good. So you may pay more for it.
Yes.
So these are the ways that bonds will react in the market. Now, one thing is, to look at in terms of bond market is the market tends to be fair amount less liquid, at least in my experience.
Right. So you're very limited.
In my very limited experience. But if you go on and look for quotes for well-health debentures, again, using it as an example, if you were to go look for quotes on well-health debentures, you're going to see a fairly significant spread.
There's a bid-ask spread.
A large bid-ask spread. But if you go and try and trade their shares, there's a very narrow bid-ask spread. So you're going to get a lot more trading in the stock than you are in the bonds.
So now you mentioned that bonds are much more illiquid than stocks. Is that one of the issues going down with the whole bank debacle right now in the States?
So
the illiquidity?
So from my limited understanding of what happened with Silicon Valley Bank, going back to our prior example, is they bought long-term bonds.
And long-term meaning like the 30-year bond.
Oh yeah, you can buy bonds, short-term bonds are under 5 years. Yep. Mid-term bonds are 5 to 10 years, and long-term bonds are over 10 years. Right. And you can buy them as long as 30 years, and I think you could even buy them longer than that. So let's say they call it 30-year bonds, or even 10-year bonds. Let's say they bought 10-year bonds. Well, they have to hold those bonds for 10 years to get their principal back.
Right. So we said, if you want your principal back, you have to hold to maturity.
Yeah. Right. So with that, they bought with maybe the intention of holding for 10 years. So, and if they bought those bonds maybe a year and a half, 2 years ago when interest rates were very low. So let's say they bought those bonds when interest rates were 0%, and now they're up to, again, 3.5%. The price of those bonds is going to drop considerably because who wants to make 0% when you could make 3.5%? Okay. But now you have people requesting money, but they don't have the money. The money is tied up in the bonds. They don't have the liquid cash. They had to sell some of those bonds at a loss in order to give people the money to take out.
Right. So
and it's a snowball effect. Essentially, someone's going to be stuck holding the bag because at some point, let's say they had...
Taxpayers.
Well, in this case, it ends up being taxpayers. But, at some point, if the taxpayers don't backstop it, what ends up happening is someone's holding the bag and doesn't get their money. They put in, $20,000 that... If you're the last one to go to the bank and try and take out your money, the bank goes, I'm sorry, we don't have your money anymore.
It's a very scary situation, and it really shows you how fragile the banking system is. And I know there's a lot of theories out there, and I'm not an expert, and you're not an expert.
Not on that.
But it's very interesting to see, even with all the theories, if there's one thing that you can take away with everyone talking about it, is that the banking system is fragile, right? And money makes people do crazy things. Money makes individuals do crazy things, and money makes bankers do crazy things.
Yep.
And when people do crazy things, bad things can happen.
Yeah. The Silicon Valley debacle is actually a very interesting case study on bonds, actually, if you kind of really research as to why it's happened, and we've just kind of scratched the surface of it.
Right.
But read some of the news articles, and what some people are saying as to why it happened will actually help you understand bonds and bond valuation maybe a little bit better. Now, there's some moderately complex formulas that go into calculating the value of a bond, and we'll get to that hopefully next week.
Yeah.
We'll kind of show you how to do some examples of that.
And what you would be looking for. So in summary, there are quite a few different vehicles that you can use for fixed income. There are GICs in Canada.
Yep.
There are bonds. Yep. There are debentures.
Bankers' acceptances. Treasury notes, T-bills.
Treasury notes. We didn't get into those.
We didn't get to those. They're essentially government bonds.
Yeah. So there's quite a few, there's numerous ways that you can get into the fixed income market. If you want a fixed income
of cash flows,
and you don't necessarily, you're not looking to participate in the growth of a company, although we did touch on convertibles, then fixed income or bonds or debentures are a great tool for an investor. It's a lot of homework. It's a lot of digging. It's really boring. It can be really boring, but it's fun to make money.
Oh, it's very fun to make money.
Yes, so the boring part pays off.
Well, and that's the thing. I think there can be some value there. Some people have made a lot of money just buying and holding bonds.
Exactly. Yeah. So next week, we will get to actually valuing bonds.
Yeah, and doing some calculations.
And going through it that way. And
both manually and by financial calculator.
Yeah. And the manual, like you said, is really helpful because it helps you to really understand why are we using these numbers? What do these numbers even mean in the calculation?
Yeah.
So I think we'll wrap it up there.
Yep.
There's not much more to say. Do you have any comments or book recommendations for bonds? Because we've been having a hard time finding them.
And that goes back to what you were saying before. It's very difficult. You can find all sorts of stock valuation books and stock books, but it's very hard to find a book on bonds.
It really is.
Yeah.
So if you have any recommendations, leave them in the comments. And if you can like and subscribe this video, that really helps us. See you next week.